Tax preparation strategies for senior citizens. Tax preparation for seniors represents an evolution from simply reporting employment income to managing a complex portfolio of retirement distributions, government benefits, and age-related credits. Senior citizens in the United States must be particularly aware of the senior deduction, a temporary benefit introduced for those 65 and older. This deduction provides up to $6,000 for single filers or $12,000 for couples filing jointly, helping to offset the rising cost of living. Because this deduction phases out for higher earners, early year-end planning is essential to ensure that total income stays within the optimal thresholds. Understanding how this new provision interacts with your existing tax bracket is the first step toward a successful filing season. A cornerstone of senior tax strategy remains the effective use of the standard deduction, which offers significantly higher thresholds for those over 65. In 2025, the base standard deduction has increased to $15,750 for single filers and $31,500 for married couples, but seniors are entitled to an additional age-base amount on top of these figures. This effectively raises the zero tax threshold, meaning many seniors may not even be required to file a return if their income remains below these combined amounts. By calculating these total exemptions early, retirees can determine how much additional income they can draw from taxable accounts without triggering a federal tax liability. The management of required minimum distributions is perhaps the most critical technical task for those aged 73 and older. Failure to withdraw the correct amount from traditional IRAs or 401k plans by the year-end deadline can result in a steep 25% excise tax on the amount not distributed. To mitigate the tax impact of these mandatory withdrawals, savvy seniors often utilize qualified charitable distributions. By directing required minimum distribution funds directly to a qualified charity, the money is excluded from taxable income altogether, satisfying the legal requirement while keeping the taxpayer's adjusted gross income lower. Social Security taxation is another area where strategic planning can yield substantial savings throughout 2025. While Social Security is often thought of as tax-free, up to 85% of benefits can become taxable if your provisional income exceeds specific levels, $25,000 for individuals or $32,000 for couples. This creates a tax torpedo where a small increase in pension or IRA income can suddenly expose a large portion of Social Security to taxation. Seniors should coordinate the timing of their withdrawals to stay below these cliffs, potentially using tax-free Roth IRA distributions to bridge any gaps in their monthly budget. Medical and accessibility expenses represent significant potential deductions that often go overlooked by older taxpayers. For 2025, the Home Accessibility Tax Credit remains a vital tool for seniors making home modifications like ramps, walk-in tubs, or grab bars to improve safety. Additionally, the threshold for deducting medical expenses is generally 7.5% of adjusted gross income. However, since seniors often have higher recurring healthcare costs, keeping meticulous records of premiums, dental work, and even travel for treatment is vital. These deductions can be particularly powerful when paired with the disability tax credit if the individual meets the criteria for prolonged physical or mental impairment. Investment strategies, such as tax loss harvesting and pension income splitting, offer further avenues for reducing the 2025 tax bill. For couples, pension splitting allows a higher-earning spouse to allocate up to 50% of eligible pension income to the lower-earning spouse, effectively utilizing lower tax brackets and reducing overall household tax. Furthermore, if you hold investments in non-registered accounts, selling underperforming assets to offset capital gains can lower your taxable income. This is especially useful in 2025, as it can help seniors stay under the income caps for the new senior bonus deduction and avoid old age security clawbacks. Finally, the importance of professional consultation and digital record keeping cannot be overstated in this shifting regulatory environment. With the introduction of the One Big Beautiful Bill and its temporary provisions, the standard way of filing from 5 years ago may no longer be the most efficient. Engaging with a tax professional or utilizing specialized software can help identify state-specific credits, such as property tax grants or transit credits, that vary widely by location. By staying proactive and organized, senior citizens can ensure they are not only compliant with the law but are also maximizing the wealth they have worked a lifetime to build. We welcome you to subscribe to our YouTube channel for more informative videos on tax and finances. Thank you.